Back in December, Vanguard's target date index funds crashed to the tune of 10 to 15%. If you look at the share price of a Vanguard target date index fund, you can see on a single day the share price dropped by over 10%. But investors didn't actually lose that money. The drop was paid out as a long-term capital gain distribution. I explain more about how it worked in my video here. You can see in my Vanguard account, on the day that drop occurred, it actually paid out a distribution of about 10% of the value of the fund. That payout has a big tax implication. And when that happened, we didn't really know why it happened. Now we do. So in this video, I'm going to explain exactly why this payout occurred, how big of a deal it is, and what to do now that we know. First of all, this big distribution was not normal. If you look at the Vanguard target date fund distributions, you can see that last year, at the end of 2020, the distribution was only about 1.8 cents per share. But at the end of 2021, it was over $4.83 a share. That's a 263 times increase in these long-term capital gains distributions. So that's not typical. So let's break down why it happened. To understand why this happened, we actually have to look at the two different target date funds that Vanguard offers for each target year. For example, in 2050, there's VFIFX, which is the investor share class. It has an expense ratio of 0.15% and a minimum investment of $1,000. But there's also an institutional share class that has a slightly lower expense ratio, but a $100 million minimum. That institutional share class is basically designed for big companies who have 401k plans with like tens of thousands of employees who are all pooling their money. You can see here, this is the institutional share class with that huge minimum investment, but this is actually back from 2020. Something changed after this when Vanguard dropped that minimum investment from $100 million to $5 million. So you can see now in 2022, the minimum is only $5 million. I believe that had a big unintended side effect that Vanguard wasn't prepared for. If you look at the flow of funds into and out of VFIFX, which is the 2050 investor share class, over most of the time from 2012 to 2020, money was flowing into the account as typical. But in 2021, money was flying out of the account. Where was it going? Well, all those institutions that had between $5 million and $100 million in their plans, they were able to then upgrade to the institutional share class, thus pulling their money out of the investor share class and into the institutional share class. We can see here on the flow of funds for VTRLX, all that same money that was flowing out of VFIFX is now in the institutional share class. That had a big impact on the investor share class because Vanguard basically had to come up with all the money to move it out of that fund. And to do that, they had to sell all the underlying funds. Selling all those underlying funds resulted in realizing huge capital gains, which are passed on to the individual investors. The Wall Street Journal even wrote an article about this, calling it a change that benefited big clients and left little ones holding the bag. That article went on to quote an investor who said, "I'm screwed by Vanguard, resulting in an enormous tax bill." And it said, the funds aren't ideal for taxable accounts. So let's look into exactly how non-ideal they are. What was the real tax impact of this? So to understand the tax implication of this distribution, let's look at an emoji example of Ashley and Amanda. They both invest $5,000 into a target date fund like this. Let's fast forward 7 years and say the value of both of their funds has doubled. So they have $5,000 of principal, how much they paid, and $5,000 of growth as an unrealized, untaxed gain so far. Then let's say that this Vanguard target fund payout happened to Ashley. So in this case, Ashley loses $1,000 of her growth. That was that drop in the share price we saw. And in exchange, she gets $1,000 in a dividend or in a distribution, which is cash. And so let's make some assumptions about this. Let's say Ashley and Amanda are both in the 20% capital gains tax rate, which is the highest federal tax rate right now. We'll also say, because of that, she had a $1,000 distribution, and so she has to pay 20% of that to tax, which is $200. Looking at the situation here, it's clear that Ashley has a $200 tax bill. Amanda doesn't have a tax bill because she didn't get this distribution, and this is basically what that Wall Street Journal article and all the upset investors are talking about. They're getting this tax bill when they weren't expecting it. But let's continue. With the rest of that $1,000, that's going to get reinvested. Since Ashley wasn't planning to sell, she was planning to continue investing. That remaining $800 gets reinvested. I'm a little too high. There you go. And so where does that leave them at this point, 7 years in? Well, now Ashley is basically $200 down. She had to make that $200 tax payment to the government and is left with $9,800. And Amanda still has her $10,000, her total growth from doubling her original investment. But note that it's not exactly the same because Ashley's principal, her tax basis now, is $5,800 because that $800 was already taxed as part of that distribution when she paid the $200. So Amanda actually has more of her investment in an unrealized, untaxed gain in the growth section. So now let's fast forward another 7 years. And so now their investments have doubled yet again. And so Amanda's doubled from $10,000 to $20,000. And so her principal is still $5,000 and has $15,000 in unrealized gains. And then Ashley has now doubled to $19,600. And so now she's trailing by $400. So you can see because she had less, the additional growth has actually set her back. But again, that's not the whole story because they still have this unrealized, untaxed gain. So let's say at this point, they both want to sell everything and actually take their money out and use it to spend it. Let's again assume that both of their tax rates are 20%. In this case, Ashley would pay $2,760 in tax on her $13,800 of unrealized gains, and Amanda would pay $3,000 in tax. So now, 14 years later after they started investing, Amanda is actually paying more tax because she wasn't taxed earlier when that capital distribution occurred. So where does that leave them? Well, after all the taxes are paid and they're totally cashed out, Ashley ends up with $16,840 versus Amanda's $17,000. That means Amanda wins by about 0.95%. Not per year, but over the 14 years in this example, she wins by less than 1%. And if you annualize that, it's only about 0.07% per year. You can see their annualized gains, given this doubling every year after tax, is 9.06% for Ashley versus 9.13% for Amanda. Ironically, that 0.07% difference is actually the difference in Vanguard's new expense ratios. So Vanguard is actually, unrelated to this capital gain distribution, is lowering their expense ratios on their target date index funds. They used to be 0.15%, now they're 0.08%, and so they're actually being lowered by 0.07%. So this taxable inefficiency to the tune of 0.07% in the example we gave, it's actually being undone by this lowering of their expense ratios. So overall, so far, it doesn't look like a big deal. However, we did make some assumptions here. We assume that they're paying a very high rate of tax. 20% is the top capital gains tax right now for US federal taxes. If they were in a lower tax bracket or a zero tax bracket, as some capital gains are, then this would be irrelevant. In fact, it would even be a good thing to have the distributions happen earlier. That can sometimes even be referred to as tax gain harvesting. We also assumed a constant tax rate. So we assumed 20% when they had the distribution and 20% when they sold. If their tax rate went up or down, that would change the math. For example, if their tax rate went up a lot in their 14th year, Ashley would have ended up better because she would have paid more of her tax up front at that lower tax rate. Of course, the inverse is true too. If their tax rate went down, getting taxed earlier at a higher tax rate would be worse. And I also assume that their distribution occurred at their halfway point at 7 years into a 14-year investing time frame in this example. It turns out the earlier the distribution happens, the longer or the bigger magnification impact it has. So let's look at kind of the most realistic extreme example. We could say, okay, what if she had a 50% tax rate when the distribution occurred and a 0% tax rate later in life? But that's not realistic. So let's assume the tax rate is still consistent, but the distribution happened right when they started investing. In this worst case scenario, Amanda would actually win by 2.91% total, or about 0.22% per year. Now we're kind of getting into where it's significant, certainly more than the drop in expense ratio that Vanguard just offered, but still not a massive difference, and this is kind of the worst case scenario. So should you stick with a target date fund? Well, there are some advantages to doing so. For example, you get the simplicity of investing in a single fund. That fund is auto-rebalancing and auto-reallocating as you age, and it eliminates human error. If you were to invest in individual funds, you have to make a lot of those decisions both initially and as time goes on. One good alternative is a 3-fund portfolio. It's basically buying the funds that are inside of a target date fund, but buying them individually or a la carte. It can be made up of either ETFs or index funds. You do need to choose your asset allocation, how much of each fund, and you could just copy what's in the underlying funds of a target date fund. You should reallocate as you age so you're not too stock heavy when you're later in life. And rebalancing or reallocating can actually cause yet another taxable event or inefficiency as you sell some of your stocks with huge gains and buy some bonds. So in summary, this is irrelevant inside of tax advantage accounts. If you own a target date fund in an IRA or a 401k or a 403b or a TSP, this is all irrelevant to you. It's only about taxable accounts. Even in taxable accounts, it's not a huge deal. We saw that in the worst case scenario, we're talking about 0.22% annualized, and a more typical average case scenario is about 0.07%, which was balanced out by Vanguard actually reducing their fees. All things equal, I'd probably go with a 3-fund portfolio inside of a taxable brokerage account. It's just one more way to reduce those fees just a little bit and hopefully maximize your gains. But at the end of the day, remember, this isn't really a big deal. Stick with the target date fund, go with the 3-fund portfolio. That doesn't make a big difference. What really makes a difference is following the 2 rules of building wealth, which is rule number 1, live below your means, and rule number 2, invest early and often. If you do that more, you'll be more wealthy. Getting the exact tax efficiency right isn't really a big deal. See you next time.